So increasingly, I'm getting more and more private DMs, PMs, messages asking me, hey Chiking, is it a good time to buy into Disney stock? Is PayPal a good valuation now? Can we enter into Intel, etc., etc.? So there are many of these so-called popular value stocks that are floating around in the YouTube scene, where you see a lot of more value-inclined YouTubers basically talking about how this might be a potential opportunity. So if it's a one-off request, I tend to write them off because there are a lot of things on my watch list right now. However, when I aggregate them together, there seems to be a very keen interest in some of these particular names. So I don't proclaim to be an expert, but this is basically just my very brief understanding of the company because I really just wanted to investigate whether this is a good opportunity to enter as well. Because hey, all of us just want to make money from the stock market, right? So if there's enough support for this kind of video, it might be a new series. So particularly in this video, let's dive a little bit deeper into Disney. So I think all of you probably know of that brand, the Mickey Mouse. So when I was looking into the company, there are particularly three key problems. Number one, it's on the cannibalizing on their legacy business, which is the cable TVs. Number two, it's in terms of the streaming war right now with Netflix. And number three, it's the box office and the overall reputation of Disney. So let's go into them one by one. So firstly, about cannibalizing of their cable profits. So at least for those of you who have been studying the company, you probably have noticed of this very worrying trend, which is the transition from linear networks to DTC, which is direct to consumer. So if I were to just cite some of the numbers, in their latest Q4 2023 results, so the revenue from linear networks was actually down 9% year on year, from 2.9 billion to 2.6 billion. On the other hand, DTC, which is direct to consumer, essentially the Disney Plus subscription, is actually up 12%, 4.5B to 5B. So intuitively, you know that Disney's business now is currently in this transition period where they're all basically going online and they're slowly phasing out the cable TV. However, the more important factor is if you actually go down the income statement and to look at the operating income. So the operating income from the linear networks actually stayed at $800 million, flat year on year, even though top line revenue is actually down 9%. On the other hand, direct to consumer is still making a huge loss. Loss is slowly narrowing from negative 1.4 billion to negative $400 million. So it's true that Disney Plus and the entire streaming business is growing healthily, but is still making a loss. On the other hand, linear networks, which is the most profitable segment, it's basically on a decline. And it's quite telling from the three statements that they're trying their very best to basically maintain the profits. But it can't go on forever because we know that cable TV is a dying business and it will slowly be phased out. So you can see on aggregate, the operating income for that quarter for Disney is at around $3 billion, 2.97 to be exact. And 800 million actually came from linear networks. So that's nearly 1/3 of Disney's entire operating income. That's why there's many concerns around how they're able to replace this income for the business itself, and whether DTC is able to hit that critical point or to hit that critical juncture soon enough in order to sustain the business. So if you were to look at it from the different business arms of Disney, entertainment is actually half of their revenue, at around 9.5 billion out of $21 billion. And out of that 9.5 billion, 2.6 billion is from the linear networks. In this case, you can see that it paints a really devastating and pessimistic outlook for Disney as they slowly phase out one of their most profitable segments for something that's not so profitable. They haven't really figured out the kinks, yet at the same time, they're having a very hard time to convince investors that they have a very good story to sell. And if you were to look at it in terms of how much they have produced in operating income on an annual basis, they actually hit a peak of $14.8 billion back in 2018. And if you look at it on the last 3-year basis, it's 3.5 billion, 6.8 billion, and 9.3 billion. So even at the most latest last 12-month figure of 9.3 billion, it's still a far cry from its peak of close to $15 billion. And that's a 1/3 shave off, or more than a 1/3 shave off. So they are now having a very hard time trying to sell the story to investors that they are able to recover very strongly in terms of bottom line profits. And more importantly, here's an interesting observation. So back in 2018, it was essentially peak performance for the entire overall business. And on a free cash flow basis, they were producing around $9.8 billion. And that was on a much lower revenue base at around $59 billion. So $59 billion revenue, they produced $9.8 billion free cash flow. The funny thing is, in 2023, they actually reached a record peak in revenue because the revenue actually grew from 59 billion in 2018 to 89 billion in 2023. So that's around a 50% increase in the last 5 years. However, The free cash flow, it's at 4.8 billion. So top line revenue actually increased by 50%, but bottom line free cash flow actually shrunk by 50%. So free cash flow margin is basically shrinking rapidly. And this is a very hard pill to swallow, but I guess one silver lining in their most latest quarter is that they're actually on track to achieve $7.5 billion worth of cost savings. But underneath this, when I look at it as a prospective shareholder, is that out of this 7.5 billion, 4.5 billion saving is on content spend. And if you to really think of it from a fundamental perspective, let's ignore all the storytelling. Let's ignore whether Disney has a good reputation or not, whether they're able to produce blockbuster movies or not. What business is Disney in? They're in the content business, they're in the IP business. They need to protect their intellectual property. And if they're not going to continue building on this mode of content, then what is Disney going to do? So for investors that are in love with the SGX market, I've got good news. Webull has recently enabled SGX trading, and you can enjoy zero commission trading for up to 3 years. Furthermore, for those of you with idle cash sitting around in SGD, you can now take advantage of their Money Bull promo that gives really attractive yield. Webull is currently also dishing out insane welcome rewards for new users, and you can potentially get up to 25 free shares if you fulfill all the sign-up requirements. More about that later. So personally, I've been using Webull for more than 1.5 years now, and I've never looked back since. So they've constantly improved their user interface, platform features, and it has essentially helped me streamline my entire investment process. So when looking into a new company, some of us might just want to have a high-level understanding of the basics. And in Webull's native app, you can actually click into the company section, and it will provide you with an overview of the company's past financials, key indicators that you can play around with, and even peer comparisons amongst its competitors. So these numbers and rankings allow me to make a split decision on whether I should look into it further, and thus it has saved me a lot of time in terms of filtering for companies to look into. Furthermore, Webull also offers a global community which allows you to interact with other fellow like-minded investors. So you can share your experience, your insights, and tips about the market in this community. Sometimes all you need is an opportunity to bounce ideas with other investors. So to give you an example, let's say you're currently interested in a stock. So you can first search for the stock in the Webull app, click onto feeds, and you can see a quick sentiment analysis on whether investors are currently bullish or bearish. Subsequently, you can scroll into the individual forums to understand what other investors are discussing about the company and make your own judgment and decision from there. So speaking about stocks, new users to Webull can now use the link below to create, fund, and maintain any amount to receive 5 free shares worth between $3 to $500 On top of that, if you actually subscribe to at least $500 worth in Money Bull and maintain it for at least 30 days, you can get an additional 20 free shares. You probably don't want to miss this. Also, Webull currently has a transfer and maintain campaign that allows you to earn rewards worth up to $2,200. Last but not least, their Money Bull campaign has never been better. They have since lowered the requirements to participate, and you just need to fulfill 2 key steps. First, tap on to participate now and complete an initial funding of any amount during the campaign period. Second, subscribe to Money Bull and maintain the net cumulative deposit amount until the stipulated event period, and you'll be able to enjoy cash vouchers worth between $80 to $3,000. Look, Webull is currently extremely aggressive, and I hope that you make full use of it. Sign up with the link in the description below, and thank you Webull for sponsoring this video. Go on to the second problem, which is losing out on the streaming war. So we all know the king of streaming is actually Netflix, and they added 13.1 million subs in their most recent quarter. And they had a total of 260 million subs based on the last disclosure. So Disney Plus, on the other hand, in the previous quarter, had right around 112 million subscribers. So they haven't really announced the most recent earnings. So we'll keep our eyes peeled in terms of trying to have a more baseline comparison or fair comparison. But if you were to really boil down to this entire streaming war, it's really one word. It's called desirability. Desirability of their content. So personally, I'm actually a consumer of both. I have a Netflix subscription, but I've actually stopped my Disney Plus subscription because there really isn't something that I'm looking forward to. So I guess even from a consumer perspective, I'm finding it a very hard time to try to justify the subscription. And on the third point, which is really the idea of their box office suffering, which is a symptom to a larger problem where their content is no longer desirable. So if I can quote, Instead of recapturing the studio's magic, Wish actually joins a long list of its underperforming 2023 tentpoles, such as The Marvels, The Haunted Mansion, and Ant-Man and the Wasp. So this summer's The Little Mermaid didn't completely flounder with $569 million worldwide, but it's nowhere near the billion-dollar threshold that Disney's prior live-action adaptation surpassed with ease. Pixar actually hasn't restored its former glory after audiences were trained to watch on Disney+. So even the new transition to Disney+, where everybody is going on to streaming, going on to online, is also cannibalizing on the movie experience and the entire content and IP rights. So I think in the short term, you can't really blame the management team. Disney is stuck between a rock and a hard place. There's this wave of transition where everybody is going online, yet at the same time, Disney still has a lot of legacy business. I mean, you can blame the management team for not having the vision to kickstart this process sooner, but Disney is really doing whatever they can to try to soften the impact and to still deliver some sort of shareholder return. But I think trying to do cost savings on their content spend, that might not be a very well thought out move, at least in the long term, if you are really in it for the long term. They're actually levying a lot of debt on their balance sheet. And from less than $10 billion, they actually took up nearly $42 billion in long-term debt right now. So things are definitely not looking too pretty. So of course, not everything is doom and gloom. If you actually track their quarterly earnings, their park experiences actually continue to recover. And personally, I've talked to friends that went to Japan, to Hong Kong, Disneyland specifically. It's jam-packed. So on the positive light, revenue and earnings in the park experiences will probably continue to normalize, but the actual experience on the ground is not too good. Queues are too long, you can't really buy priority passes. It's too crowded. So I guess it really depends on how Disney is going to manage many of these expectations moving forward. On a more macro level, at least on the management team perspective, they actually transitioned back to their old leadership. So we do know that there's some issue with leadership transition. So that actually opens another whole can of worms. So in short, I think it's very easy to attribute the problems to Disney because you can see the share price actually collapse by quite a large extent. So how do we actually look at this entire investment thesis? So I think it really boils down to two things. Number one, I think it's largely dependent on whether the new team that comes in, are they able to turn this around? Two, whether they are able to skillfully scale up on Disney Plus and be something like a Netflix or a Netflix-worthy competitor, at least in the next 5 to 10 years. Presumably that you are really a long-term shareholder that wants to walk together on this journey with Disney, they really need to make their streaming work. If not, there's no two ways around it. And Netflix continues to eat the lunch of many of its competitors. Considering all of these factors, I actually came out with a very simple DCF model. You can see this is basically my projection. 2018 to 2023, there's nothing to argue. All these are past figures. For 2024 alone, I'm expecting their cash from operations to recover, and not even to their peak of $14 billion in 2018, but slowly gearing up again to $12 billion. And specifically for the capex, they actually guided $6 billion. So I'll just deduct $6 billion from it. And from 2024 onwards, I'm going to project out for 4 more years. Cash flow from operations, 15, 15, 10, 10. Capex, I expect them to normalize and to just stay at 5%. And I use a terminal free cash flow multiple of 15 times. So I think if we just do 100 divided by 15, that's around a 6.6% free cash flow yield. So I think that's a fair price to free cash flow multiple to tag onto a business like Disney, because it's very uncertain now and it's really dependent on whether they can make this streaming idea work. So for the discounting, I use a WACC of around 9.7%. You can actually just Google the number. You can actually just move the number around depending on how comfortable you are. And I got a price target of around $84. So at Disney's current share price of around 95, it's actually slightly overvalued, at least based on this current assumption. So I'm not saying that this is the be-all and end-all and the intrinsic value of Disney is at 84. No, I'm just trying to produce my expected outcome and expected assumptions, throw it all into this model, and then it spits out this particular number. If you're more bullish, you can use a higher terminal free cash flow multiple, you can use a lower discounting, you can massage the number, and you can get a very optimistic intrinsic value. I think that's not the point of this exercise. At least to me, the point of a DCF exercise is really to see the range of outcome and scenario and which you think is most likely.
So if to go back to observe Disney's historical valuation range, specifically the price to free cash flow multiple, they do trade between the range of 18 to 25 times. So if to actually edit it into the model itself, using the exact same assumption for the discount rate, the growth in cash from operations and the growth in capex, actually Disney's share price would be right around trading at intrinsic value. And if you're to bump up the terminal free cash flow multiple to 25 times, there's actually an upside of 35% with a price target of around $129. So as you can see, you can achieve any price target as long as you're willing to massage the numbers. But I believe my point still stands here, especially when there's a lot of uncertainty around Disney today. It's my personal belief that the market finds it very hard to tag a premium multiple to Disney's core business. So unless we see some sort of reversion in terms of the earnings and the cash that they produce, and especially so if they're able to turn the switch on for their streaming business, if not, I'm still adopting a wait and see approach.
That said, Disney is essentially a recovery play, and you're betting very heavily on the uncertainty of whether they're able to turn the ship around or not. So that's basically my preliminary thoughts. So personally, I would be interested in Disney, and I don't mind paying a little bit more premium in valuation, waiting for it to recover a little and to produce more impactful and more positive results. So that's basically just my perspective. I'm going to include it in my watch list. So I hope you guys enjoyed the discussion. And if you like this series and you want me to talk more about some of these popular value names like Intel or even PayPal, please feel free to leave in the comment section down below as well. If not, I'll see you guys in the next video, and more importantly, I'll see you guys on the moon. Goodbye!